Welcome to today's presentation about the MAXIM Market Mover indicator, developed for Metaquotes trading platform by MAXIM Trading Strategies. Section 1 is about the indicator, and then I will be discussing and also showing you the Market Mover indicator on the MT4 platform and its trading signals and rules. The final part of the presentation, in Section 3, covers the alert notification. The Market Mover indicator uses a number of standard technical analysis methods to provide a robust overall indicator, combined with simple trading rules in order to trade G10 Fx currency pairs. The four methods used are as follows: exponential moving average crossover, relative strength index, multiple time frame analysis, and volume spread analysis. These methods can be researched online if any user is not fully aware of them. Something which may be of interest to users is our VSA analysis and how volume can be an important way of analysing FS markets via tick volume. I have saved this study paper at the following link. This study uses data provided by leading banks showing the high correlation of tick volume and traded volume. It confirms that FX markets do lend themselves to volume spread analysis. Here we go to the USD JPY or dollar yen currency pair price chart. I have loaded my standard settings and used the commonly used red and green candlesticks. I will now load up the MAXIM volume and range indicators, which are a prerequisite for using the MAXIM Market Mover indicator. When the MAXIM Market Mover indicator is first run, a dialog box appears. Here, you can disable the alert notification by changing the alert disable property from 0 to 1. The default is for the alert notification to be on. The alert is an audio and text dialog window that informs you when a trading signal in the Market Mover indicator is pending. It also provides a summary of the trading rules. The demo version of the Market Mover indicator does not come with an alert notification. The Market Mover indicator has its own window and draws a red or green coloured vertical line when a trading opportunity arises. As you can see, there are triangular lines in the window. These are just anomalies of the MT4 trading platform and should be ignored. The green vertical line on the 1 hour time frame indicates that a long trade is pending, and a red line is for a pending short trade. Following the trading rules will inform you if you should take the trade or hold off. The analysis by MAXIM Market Mover takes place on all time frames, but a valid trading signal is only produced on the 1 hour. The trading rules use the 1 hour as a medium-term trending time frame, whilst the 4 hours used as a longer-term trending time frame. The 15-minute is the time frame on which entry, stops, and profit target orders are to be placed. When trend trading, it is important to use multiple time frames to identify the trend. The 4-hour chart is the strongest time frame on which to identify a trend. The trend is confirmed on the hourly chart and trade execution is on the 15-minute chart. A bullish trend is expressed when the 10-period EMA is above the 20 and both are above the 50-period EMA. A bearish trend is when the 10-period EMA is below the 20 and both are below the 50-period EMA. Trading using this analysis is only suitable for intraday trading. Having seen the bullish trading signal in the dollar-yen 1-hour chart, the first trading rule is to confirm if the trend is bullish on the 1-hour and also the 4-hour chart. The bullish trending EMAs should also be at a positive slope or gradient. The steeper the slope or gradient of all the EMAs, the more bullish the trend. The second rule is that the EMAs must not be entangled or touching on either the 4-hour or 1-hour chart. If they are, this is not conducive to trend continuation and a lower time frame does not need to be assessed and the long trade should not be entered. But in this example, both Rule 1 and 2 are obeyed, so we can go to the 15-minute chart to execute our long trade. We use limit buy orders on the 15-minute chart to catch the first retracement back to the 10-period EMA. Orders should be placed just above the EMA to ensure you get filled. Our stop is placed here just under the 20-period EMA to ensure we don't get stopped out and miss the up move. If you are a trader that likes to scale or fade in, then put some of your lot size at the 10-period EMA and the remainder at the 20-period EMA, with your stop just under the 50. Where to take profits is really down to you. It is a function of the amount at risk in pips or monetary terms, but the risk-reward ratio must always be above 1. After some analysis, it is recommended that a risk-reward ratio of 1.4 should be used, or profits taken when the price closes above the previous high. If the trend is on the back of a fundamental move in the market, then a trailing stop can be used to extract the most from the move. If Rule 1 and 2 have been adhered to and we are to enter a trade, then the third rule is to establish how long we should wait for price to retrace to the 10-period EMA or for the 10-period EMA to retrace the price. From analysis of historic price charts, we say that one should wait for 2 hours after the bullish signal. After this time has elapsed, one should hold off and should wait for another trade signal. This is due to the fact that bullish momentum would have reduced and the likelihood of another leg higher is much lower after 2 hours. The exception to this is when there is bullish market fundamentals, and one should then wait until price does retrace to the 10-period EMA or the EMA touches price, no matter if 2 hours has passed. Since this is not an expression of a lack of momentum, but buyers have been too strong for any retracement to occur, and any selling has been absorbed by buyers, therefore holding up price. Due to bullish fundamentals, this late retracement to the 10-period EMA, or when EMA reaches price, there is a higher probability of another leg higher. So entry, stop and profit target should be placed as before on the 15-minute chart. These issues are also applicable when the MAXIM Market Mover displays a valid bearish signal. Here we'll find a bearish red trading signal and utilise the bearish trending strategies. If we go to the Euro GBP or Euro Sterling pair as an example and look on the 1 hour chart, we can find a bearish signal. When it comes to bearish signals, we look for the inverse trending characteristics to those of a bullish green signal. These will form the rules for trading short. The first trading rule is to confirm if the trend is bearish on the 1 hour and also on the 4 hour chart. In both cases, the 10 and 20 period EMA should be below the 50 period EMA. The bearish trending EMAs should also be at a negative slope or gradient. The steeper the slope or gradient of all the EMAs, the more bearish the trend. The second rule is that the EMAs must not be entangled or touching on either the 4 hour or 1 hour chart. If they are, this is not conducive to trend continuation, and a lower time frame does not need to be assessed, and a short trade should not be entered. In this example, both Rule 1 and Rule 2 are obeyed, so we can go to the lower time frame or 15-minute chart to execute our short trade. We use limit sell orders on the 15-minute chart to catch the first retracement up to the 10 period EMA. Orders should be placed just below the EMA to ensure you get filled. Our stop is placed here just above the 20 period EMA to ensure we don't get stopped out and miss the down move. If you are a trader that likes to scale or fade in, then put some of your lot size at the 10 period EMA and the remainder at the 20 period EMA, with your stop just above the 50. The same risk reward ratio for bearish trades are used as for bullish trades, or profit taking can take place when price closes below the previous low on the 15-minute chart. If the bearish trade is on the back of a fundamental move in the market, then a trailing stop can be used to extract the most from the move lower. These trading rules for trending markets are summarized in the alert notification, so you will always remember what steps to take, but they are quite straightforward. The MAXIM Market Mover indicator works with all G10 spot FX currency pairs where the bid-offer spread from your brokerage on the 15-minute chart is no more than 3 pips, which is well within the capability of most large FX brokerages. Here is an example of an alert notification. It shows the FX pair that has triggered the notification, the time, which is local to the brokerage, the kind of trade that is pending, and the summary of the rules that you should follow. The trading signals are synchronized to the 1 hour price candlesticks, which are dynamic price events. It is only on the close of the 1 hour candlestick that the trade signal becomes valid and is finally printed. During this 1 hour time frame, the signal may temporarily turn on and off. This transitory behavior should be ignored. If the signal is still present after the close of the 1 hour price candlestick, then the trade signal becomes valid. The alert notification is just that, a notification. One must still check the MAXIM Market Mover window to see if the signal is still valid. If so, one should use the trade rules to decide if one should trade or hold off. The MAXIM Market Mover is available in demo version for your download via your MT4 terminal or at the MQL5 community website. The demo version is free, but it only indicates bearish moves. Thus, one should only use the bearish trading rules described in this presentation or in the user guide documentation, since the alert notification is disabled. All the links will be provided at the end of the presentation. So to conclude, I have given you an overview of the MAXIM Market Mover indicator and the multiple technical analysis methods used. This was then followed by the section on the trading signals and rules, and finally on the alert notifications. I thank you for taking the time to watch this presentation on the MAXIM Market Mover indicator. Thank you.